stock market is offering a once-in-a-generation opportunity.
So if you believe that the market rebound is coming,
This is actually the best time to buy.
You can actually make money regardless of whether the price goes up, goes sideways, or go down.
a new strategy that allows traders to profit while waiting for the market to rebound.
I'll be sharing with you how I decode these market manipulation tactics.
I trade stocks with the highest relative strength performance.
I have multiple strategies in my toolbox.
And I'll be showing you how to pick and choose the right landed properties.
And I'll be doing a live trade hunt session.
I'll show you how I use this strategy. So if you're interested to learn the skills of how to become a better investor and trader,
Join me.
Join me.
join me at the Black Market event. Remember, don't let the good prices go to waste. Hi, welcome to Black Market. I'm Adam Khoo. I'm a professional investor and trader for the last 31 years and also the founder of the Piranha Profits online trading school. It's very exciting to see thousands of investors and traders join us from all around the world, so thank you for being here with us. We are all here for one common goal on how do we build our wealth, our investment and trading portfolio over the next many, many years to come. So joining me today are my fellow mentors from Piranha Profits. We have got Elson Chu on my left, who's a proprietary trader focusing on trading stocks and cryptocurrencies. We've got Bang Pham Van, who is our options tactician, who has been trading options for the last 12 years. We have got Jeff Ong, who is our property/real estate investor, who's also a fund manager managing an equity portfolio. And of course, I'm Adam Khoo. I'm an investor as well as a swing trader. So in our last panel discussion, which was about a week ago, we talked about our different investing styles and how we were managing this current bear market. So right now, we're going to continue our discussion onto the outlook for the rest of this year and for 2023. Where do we see opportunities? What's our game plan? And how do we see ourselves positioning our portfolio to maximize our profits moving forward? So if you're ready, let's begin. So I think one question a lot of people will be wondering would be, has the market bottomed? Has this bear market bottomed? And if not, how much more downside do you think there is? So let's start with Alson. What do you think?
Okay, for me, I see, currently in the market right now, I see that technically, right, we have a confirmed technical bottom based on the price action manipulation strategy. We basically have, in simple terms, what we call a bear trap. A bear trap is bullish, okay, and the bear trap actually happens on the higher time frame weekly chart, the 200 SMA. So it gives us a very high probability that a bottom is in, okay? But of course, there's still a small chance, I would say, that the market may come down.
So in trading, there's no 100%. There's always a probability, whether it's 60%, 70%. So as long as the probability is in our favor, there's a good risk reward. The right thing to do is to take a trade.
That's right.
So if it's a trade, have a stop loss. So if it fails, you cut your loss, right?
Right?
But if it's an investment, it's a good business, you just hold it because even if it goes a bit lower, it will come back up eventually. Right. Okay, so your take is we have bottomed so far for this year based on the technical patterns that you see. Right?
Now,
the double false bottom on the weekly chart.
Weekly chart S&P 500, and it also test the price action test the 200 SMA.
200 SMA on the weekly charts. Right. Okay, Bang, what do you think?
I think we are near the bottom.
Safe answer.
So why is that I'm saying it? Because I look at the past few bear markets patterns, right? I saw when the market is so volatile, like up 100 points or 50 points and down the other one, and keep doing it for many days, it's just an early signs of bottoming. I look at the past COVID crash, you see near the bottom, you see a lot of jittery, I mean, up
high
and
volatility.
down, high volatility,
Market's
up
confused.
and
Where do we
down,
go, right?
and then we got the bottom. So, and I started to see more of these in the past few days. So hopefully we are near there.
Okay.
Yeah, to add on to Bang's point, right, this reminds me of a quote that George Soros said before. Market turning points always, at market turning points, right, there's usually high volatility. So that could be a signal.
Jeff, what's your take?
For me, I'm more of a long-term investor. So I think that any time there's a discount or like 10-20% below the fair market value, I'll start accumulating the business. I treat them as businesses. So companies like Adobe and all that, I just hold on for the long term. But I think there is some support at the moment. You need to look at things like a percentage of cash holding by the fund managers, institutions. They are at record high of like back to 2008. So there's a lot of money on the standby, probably because the fixed deposit rates or time deposits are very high right now, 4 to 5% for US dollar. But I think ultimately, right, when there are signs that the Fed rates are about to peak, there will be a flood of money coming in. So I think right now is a time to dollar cost average as well. Like for my equity fund, I'm only 20% invested. For my personal account, probably about 80%. I'm keeping about 20% cash, which is about right. I'm not totally bearish. I think it's too late to short the market right now.
Okay. So if you look at all the past bear markets since 1956, and remember that the S&P 500 actually started about 56, 57, right? So in all those past bear markets, the average drawdown is about 29% of all the recent bear markets. So far, this bear market, we hit a low of 27.5%. So in other words, we could be somewhere at the average drawdown, right? And all the past bear markets, the average duration was 11 months. And this bear market, we have completed 10 months, and this is actually the 11 months. So maybe based on that, we could be statistically near the bottom. The other thing would be, of course, I agree with Elson, watching the technical charts, we did see a technical bottom based on the price action, right? But again, is it the bottom? No one can tell 100%, but it is a bottom, right? Because what happens from now to the end of the year and next year, many things we can't predict. We can't predict what the Fed will do. We can't predict what inflation data will come out. We can't predict the midterm US elections. We just can't predict all these things, right? I would say that for the next few months, if the inflation data comes out, not so bad, moderate, and if midterm elections swing to the Republicans, usually that's a bullish sign. I think if all that falls into place, I think pretty much we have bottomed for this year.
But if China does something with,
of course,
with Taiwan, right, things can...
I mean, anything can happen. If China says we're
roll
attacking
over,
Taiwan tomorrow, of course, we're going to get another
course.
bottom. We can't predict that,
Yes.
right? But to that question, if this is not the bottom, then how much further can we go? That's the second part of the question. What do you think, Jeff? If this is not the bottom, how much further do you think we could go?
I think we both calculated using one of the models, earnings models, right, from Professor Damodaran, Professor of Finance in NYU. I think we did stress test. It's about 10% to 15% downside. So that is the downside that you must be prepared to have to be able to withstand. But then think about the upside is like, as you mentioned earlier on, 4.8 times upside. The return to risk ratio is favorable to be on the long than the short at this moment, I feel, yeah.
You know, there's always a saying that you can either choose to be a bear or a bull. It's your choice, or nothing, right? Don't even do anything, right? And if you're a bear right now, and the market goes down even more, you win. You say, oh, I'm so smart, right? But the market will eventually go up. And when it eventually goes up, you'll be a loser eventually, because you'll never ever get in. Because as a bear, you always think that it will go down more the next day, and you'll never ever get in. So bears may be right in the short term. In the long run, they will never be right. They'll always lose in the long run, right? But if you're a bull, in the short term, you could be wrong. Like me, I was bullish for a few times. I was wrong. Kept going down. I look like an idiot sometimes. So short term, I could be wrong. But long term, I'll always be right. Because market will always go up eventually if you're holding good companies and the indexes. So I'd rather be short term wrong sometimes, but long term right, than short term right, but long term wrong. Okay, I think that's a good point to note. And of course, the third option is don't be a bull, don't be a bear, stay out. Of course, if you stay off the markets, in the long run, you can never beat inflation. I think research has shown over the years that at the end of the day, holding stocks and real estate is the best way to beat inflation in the long run. Although in the short term, it may go down temporarily. All right, so let's go on to the next question, which a lot of people are asking, which is, what would be the catalyst for the next bull market? So we know that after every bear market, there will always be a bull market, just as after every sunset, there will always be a sunrise. But what's the catalyst? What must happen for this market to turn into a bull? Alson, what do you think?
Okay, personally, I think that sometimes, right, you may not need a good news for the market to recover, or it may not be a bad news. So you won't know whether it's a good news or bad news that will actually drive the market back up. That's what actually the main key lessons I learned, right? Is that don't be influenced by the news or the data when you actually trade the markets. Just like investing in business, look at the business fundamentals. But personally, my gut feeling tells me that I think it will be something along the line of a Fed pivot, right? The Fed may slow down the interest rate hike, or some good news that's coming out from China that will further boost the share price. Ultimately, like I said, our decisions should still be based on the charts.
The technical price action.
Right. Yeah.
In fact, the funny thing is there are many crashes I remember where the bull market started on bad news.
Right.
Right?
Yes.
When there was all the bad news and the market went up, you say, it doesn't make sense. Why is the market going up when there's bad news? But there's the market. I think there's a saying that bear markets die on pessimism, on extreme pessimism. The bear market dies when people are too pessimistic. And at the early start of the bull market, people are very skeptical. Everyone says it's going to fail. And then the more they think it's going to fail, the more it goes up. Right? Bang, what do you think?
For me, QT is just a way for the Fed to reduce the money supply and hence in the effort to fight inflation, right? So it's all about inflation. The moment you ask what is the catalyst to make the market go higher, I think it's the inflation. Once it's confirmed that inflation is getting better and the Fed say, we're done, okay, then I think it will be a big, rallies in the market. You ask me whether the inflation has peaked or not. Look at the commodity prices dropping. Look at the logistic transportation on dropping right now, because in the past it's driven a lot by the supply chain disruption. It's now gets sorted out. It just takes some time for the home price reductions to get through the system and translating into a better inflation data.
Yeah, because the inflation data is lagging.
It is lagging.
Like
So
3
I
months
believe,
lagging. Yeah.
I believe the inflation has peaked. It just takes a little more time to reflect in the report.
Yeah. Okay.
And I think that's where the market will start rallying.
Okay. What do you think?
I think that same thing. I think is end of Ukraine-Russian war, China reopening. That will cause there will be a catalyst for the markets to recover. Fed pivot, inflation peaking, and I agree with Bang. One of the data that you look at is commodity indices, and if they are starting to come down, these are the signs that further along the line, couple of months later, the inflation data may show it to be peaking. So can stocks rise even with quantitative tightening? Well, what causes stocks to go up? Earnings per share increase, dividends, and multiples expansion. So even if you have, let's say, money supply that's shrinking, that is caused by QT, right? But you still have earnings per share rise, you still have dividend growth.
And buybacks.
And buybacks, yeah, it could happen. That's right, I missed out that. So it may not be a V-shaped recovery aided by QE, but it could still struggle to climb up the stairs, right? So it might be a U-shaped recovery, not a V-shape this time. But it's possible for stocks to go up even with QT, yes.
I think that's a really good point, because I hear many people say the market cannot go up until the Fed does quantitative easing. That means they print money again. That as long as they are doing quantitative tightening, the market can't go up. That's what I think a lot of people believe. But I think what Jeff said, let me just reinforce that what makes stock prices go up again are 4 things. Number 1, earnings of the company grow. Number 2, dividends. The more dividends they pay, the more they're worth. Number 3 is share buybacks, right? And the 4th thing is the PE expansion that comes from the money supply, right? So even if money supply doesn't go up, doesn't matter. As long as earnings go up, dividends go up, share buybacks, share price will go up. And that is why you should only buy companies that are profitable. Companies that are making money, paying dividends, and buying back shares, or buying back shares, right? But if you have companies that don't make money, don't do share buybacks, then they need the QE to go up. Those companies may never go up. So that's why stock selection is so important. Now, having said that, there's also another interesting point that the Federal Reserve in their quantitative tightening, what that means is that they are actually selling bonds in the market, all right? And they're reducing the money supply by $95 billion a month. So that's about $1.16 trillion a year that they are taking out of the market. But what people forget is that while money is coming out of the market, there's also foreign investment coming in of 1.6 trillion a year from UK, from Europe, from all around the world. They are actually buying US bonds and US stocks because to them it's very attractive. Like, for example, the Europeans. Imagine you're from Europe and you bought the S&P 500 this year. You're down, you were down up to 27% on the S&P, right? But the euro fell against the US dollar. The US dollar strengthened 17% against the euro. So if you are a European, based on currency, you are actually down only 10%, which is better than putting your money in the own European market. So in other words, because the US dollar is so strong, it's attracting a lot of foreign inflow of capital that makes up for the quantitative tightening of the Fed. So in other words, money supply may actually not be falling as much as people think. Now, I think the other point to note is also that some people say that the Fed has to cut interest rates for the market to go up. That's not true. Now, remember that it is not the high interest rates that is causing the market to collapse. It is the fact that interest rates are going up at a very fast rate. If you look at history, there were many times when the Fed funds rate was way above 4%. There are many times when the 10-year Treasury yield was 5-6% in history. And at that time, the S&P PE ratio was 30 times, 35 times, okay? So the good news, what I'm saying is that the Fed doesn't have to cut rates. They just have to stop hiking it so fast. So right now, they are hiking it by 75 basis points each round, right? 0.75%. So once they reduce that to 50 basis points, 25 basis points, the market, I think, would have a good catalyst to start rallying. Now, but a lot of people have this other concern that, yeah, but what if there's a recession in 2023? So what's the chance of there being a recession next year? And if there's a recession, what does it mean for markets? Does it mean that markets will go back down again, another bear market, or make a new lower low? So what do you guys think about that? Jeff?
Yeah, I mean, the world, unless you think that the world is going to end, right, it will recover. I mean, the stock market, S&P 500 and the Dow has survived World War I, World War II, Civil War, so it will still be around, right? And it will always be higher because the governments are always printing money. More so that now the most of the currencies are depegged from gold standard. So it will rise. I think the famous saying by Howard Marks was that when the stock markets are so low, you should be buying on the assumption that tomorrow the world will still be around. And if the world is not around, he said, it doesn't matter at all. So if you take that attitude at very distressed prices, you should be going in and investing. Yeah.
Okay. Bang, do you see a recession next year?
Yeah, but I think the market has priced in a recession for next year. So if it's going to happen, I don't think the market will collapse again. It's already priced in, right? So if it doesn't, great. Now, unless there's some political or geopolitical issue like China invades Taiwan, then things can change. But I do not necessarily think the market will continue to go down with recession being confirmed.
With recession being confirmed. Yeah. Alson, what's your take?
Okay, from my point of view, right, the recession is already mostly priced in based on the sentiment of the broader investing or trading community, based on the direction of the Fed in this past 1 year.
So the question is, will there be a recession next year? The interesting thing is I've been reading a lot of reports by economists, right? And I read that there was this economist, I can't remember from where, I think Goldman Sachs or something, and he's one of the most famous economists, and he's saying that there's an 85% chance of recession next year. Now, I read another report by another very famous economist who says that the chance of recession next year is 35%. Okay. So even among the best economists, they can't decide. So if I take 85% plus 35%, if I average it out, 50-50, right? 50% chance of recession. Now, of course, we can see the yield curve has stayed inverted for very, very long. And historically, when the yield curve inverts, it's a strong predictor of recession. So yeah, I'm not surprised that there will be a recession next year. But the question is, again, has the market already priced in the recession? In other words, has the market already dropped, assuming there'll already be a recession? I think the market has priced in probably 85 to 90% of the recession. So in other words, if there's no recession next year, we're going to go really, really high up very fast, right? But if there's a recession next year, we could still go down, but I think we'll go down at the most another 10%. And I did some numbers. This year, the earnings per share for the S&P is projected to be $215. This is the most pessimistic projection, 215. If we assume there's a recession next year, and there'll be what we call earnings contraction, that means the company's earnings will fall by about 10% during a normal recession like that. That means the earnings per share next year for S&P will be about $195. Now, if you take that $195, multiply by the PE ratio of the S&P. Now, what PE do you use? Right now, the PE is about 19 times currently. Now, what people don't realize is that when the Fed cuts interest rates, the PE multiple actually goes up. When the Fed raises interest rates, PE actually goes down. So if there's a recession next year and the Fed cuts rates, PE will go up. So if it's at 19 now and the PE goes up to 20 or 21, you multiply that by 195, it's actually higher than where we are today. So if you conservatively use a PE ratio of 17 times earnings, which was near the bottom of the 2020 crash, you multiply that by about 193.5, that gives you a PE level of
3,300 plus.
3,300, which is roughly about 10% downside from where we are today. So to me, that is kind of like the worst case scenario, another 10% down from here, but huge upside potential. But again, if it doesn't happen, then we may have bottomed for the bear market.
And to add on, if that happens, right, the next technical level, the lower technical level is at 3230. So around 3230 to what Adam said, 3,350, that level, right, is the zone to watch for a bottom.
Okay. So it's interesting that both the technical charts and the fundamental calculation, they kind of like congregate around 3,250 to 3,003. So that's how much lower it can go if we've got the recessionary scenario.
And actually, this reminds me of during the time when I traded in the trading desk. It was during a time when it was the European debt crisis. And I remember one of the senior traders actually said that do not worry about the recession in the Europe or the US because of the European debt crisis, where you actually hear like Portugal, Ireland, and so on, Greece, right, they're defaulting on the debt, they will go down and bring the economy down. But instead look for, because if everyone is foreseeing a recession, it will not be a recession anymore. The market will price in. A real crisis that will break the market is usually something that's unexpected. So unless we have something unexpected, then I think the market may go to the lower level. If not, I think recession itself will not actually bring down the market so much.
Yeah, that's one thing interesting about how markets work, right? The markets tend to price in what everyone knows. I mean, if everyone expects a recession, the market already expects a recession, there's no surprise.
Yeah, the fund managers may have done their hedging, people already prepare for it, and so on. Yeah.
That's why we keep emphasizing to our students that you should not invest or trade based on news. You can never make money consistently based on news, right? But the way to make money is to look at the price action of the charts and the fundamentals of the individual businesses. Are they good businesses? Are they undervalued? Do we see any price action, confirmation of trends or trend reversals? That's all you've got to focus on. Ignore the news. Now, there are some people who also are very worried that, hey, will the markets ever recover? Some people say it will never recover. It'll take 10 years or 20 years to recover. And in every bear market, you always have pessimists like that, the prophets of doom. So the question would be, will the markets recover, guys? And how long do you think it'll take to recover? And which sectors do you think would lead the recovery? And any individual stocks or companies that you're looking at. So, Alson, what are your views?
Okay, I think the economy is still tech-driven, right? I think the tech stocks, especially the big caps, will lead the recovery. Okay, once they bottom and they lead the recovery, the rest of the market will follow. But I do see that many of the stocks in China or even in crypto market may also give a lot of upside, given that they're already down like 80-90%.
Any specific stocks that you're looking at?
For the China market, I'm actually looking at the broader index. For example, the K-Web. Okay,
It's the China Tech Index.
tech
ETF.
index. So if you do not want to focus on just a specific stock, I mean stocks like JD, they actually form a technical bottom already at the moment. JD 241 in Hong Kong ticker, VIPS, all these Hong Kong China stock, they actually are actually forming in line with the index itself. But if you want a broader exposure, you can just look at the K-Web. And for cryptocurrency, there are also many cryptos. They are actually doing forming a nice technical bottom, a bear trap pattern like Polkadot, Cardano, this type of tokens. So these are some of the tokens I'm watching for multi-bagger gains.
Okay, how about you, Jeff? What do you say to people who ask, will the markets ever recover? How long will it take? And what sectors do you think would lead the recovery?
I think that, of course, as I mentioned earlier, the stock markets will recover if you assume that the world will still be there, right? And if it doesn't, if the world ends, then it wouldn't matter at all. So I think recovery is, a lot of the recession is already been factored in. So the recovery could take place anytime between now till 6 months. We could see at most 10% drop. And the other thing is that we know a lot of people have this misconception. To be a multi-millionaire, you really have to guess the bottom of the market right to the week. I think if you take a leaf out of the great investors who are billionaires like Warren Buffett, Peter Lynch, they do not time the market right down to the month even, right? Warren Buffett was very actively buying in the first quarter of this year, and he got it wrong. But hey, he's a billionaire. Who are we to doubt? Or Peter Lynch that achieved 29% per year, and he retired in 1994, 93. He didn't time the market at all. I mean, he just bought when the businesses are at discount. So yes, I think it will recover. I think any time between now, depending on how much more bad news or any unknowns are coming out for the, we could see a bottom in the next 6 months. But we always are ready. We always buy at a discount. Now, which sector is likely to recover? There are sectors generally that are sold down the most this year. For example, quality companies, tech companies, the tech sector have been sold down, the communication sector have been sold down a lot, worst performing sector in the last 1 year. And we have seen that we've seen Amazon, good quality companies, Adobe, Microsoft, all of them are on a subscription model. You don't see yourself terminating your subscription in a recession, right? I mean, you still need to use your Word and your Excel. So all these businesses will still be around, and they are at huge discounts now. So I think that those sectors that have been sold down a lot this year, the good quality ones, will become winners again. They always do. Yeah.
All right, how about you?
Definitely, I think the recovery will happen. It's just a matter of time, right? But unlike the last bear market or recession, where we have a flash crash and then a V-shaped recovery, I think this time it will take some time. Will take longer time to get that rebound. And it took us like 11 months now for the market to decline from the top. It could take the equal amount of time to recover. So, yeah, to recover to the on-time high again. So. And in terms of sector, which one will get the recovery the most? I just focus on the one that are still making tons of money, generating a lot of cash, and they will be around in the next many years, right? So look at companies like Microsoft or Google, Disney, Nikes. They are still big brand names. I cannot live without Microsoft or Google today, to be honest with you.
Yeah,
I do it every day. So, and they're generating cash. Their franchises are amazing. They will be around. So focus on those companies that are making money, paying dividend, and getting a lot of profit. Now, if the market takes some time to recover, that's a good news because it buys you some time to generate more income from your employment and then plow it into the market and buy the stock when they are still at the cheap discount,
absolutely.
Right?
Yeah.
And then
What's
that's
the
a good thing.
What's the rush? That's the rush.
Yeah. And in option trading, so that is for investors. For traders, options, for example, there are many strategies that allow you to make money when the market just go nowhere, right? So there are many ways for you to make money or accumulating good shares.
So you talk about some of the strategies in your webinar. How do you make money when the market goes sideways
Yes.
or nowhere for many months?
Correct.
Great.
Or even if it continues to go down a little bit more, you still make money in that strategy. So I will share with you live when it comes to my live webinar.
Yeah, so actually I agree that we probably won't have this V-shaped, very fast recovery, right? That's something I also feel that is going to like chop around, chop, a slow U-shaped recovery. And again, like what you said, that's not bad news. That actually can be good news because if you are saving for your retirement, if your goal is to be financially free in the next 5 to 10 years, this gives you a longer time to buy shares, right? You have more time slowly to accumulate shares of great companies. Because what's a rush? I always say that investing is not a sprint, it's a marathon. So you want to pace yourself during this marathon. And I also agree with you guys that I think the sectors that will rebound the most are the ones that got sold off the most, which will be technology, consumer discretionary. So let me give you some examples. So technology would be like Microsoft, Adobe, Salesforce, ServiceNow. Consumer discretionary like Estee Lauder, Disney, Nike, Amazon, right? And then communications like Google, right? Meta, once they start to cut their operating expenses, that has a lot of upside as well. And again, which companies to buy? Like what Bang said, right? Focus on companies that, to me, the most important thing is to only buy companies that dominate their industry. That means they have very little competition and they have got a wide economic moat that protects them from threats of competition. So again, your Amazons, your Googles, your Microsoft, right? And companies that generate lots of free cash flow, very strong balance sheets, do a lot of share buybacks or pay dividends. These are the companies that would go up the most once we have a change in the sentiment, once the bull market begins. So again, you may say, which companies are there? Again, in my live webinar, I'll be showing you the formula of how I select, again, the highest quality companies that meet this criteria so that you can, again, slowly accumulate to really build your your retirement or financial freedom portfolio over the years.
Yep.
All right, so those are for the stock markets. Now, how about the real estate market? So, Jeff, over to you. What's your outlook for the real estate market for the rest of the year and for 2023? Any opportunities?
I think all over the world, right, as long as you can do the B4R strategy, which is buy, refurbish to add value, rent it out, refinance or remortgage, and then recycle your money, it works. It doesn't have to be UK. But of course, I'm focusing on UK because that is where I'm most familiar, and I think that it fulfills the criteria. Now, real estate is very interesting, or I may say that it's actually simpler. You know why? Because real estate tends to lag behind the stock market. And it takes a while. Sellers are very stubborn. They hold on to the very high price until finally they say, oh, nobody wants my property. Then they'll start to drop their prices, asking prices. So we have already seen the S&P 500 drop 25%, right? We're probably going to see real estate price drop as well. In Singapore, whether in UK, US, wherever you are, we may see bargains. So if you take my course, you understand the discipline and then go through the methods, you'll be able to find good bargains. And just like stocks, there's going to be a wealth transfer. People who can't hold on to their properties, they are over-leveraged, they are on negative cash flow, they lost their jobs, they're going to start to sell their properties, okay? They're going to downgrade, and their loss is your opportunity. I mean, there's nothing unethical about buying property from motivated sellers. Is that if they don't sell it to you, they'll probably sell it to someone else as well. So it might as well be you. So through my course, you're going to learn how to analyze and find such opportunities. So I'm actually quite excited with the recession. I'm preparing a cash hoard to start to accumulate properties for the next 12 months. Yeah.
So you do see prices softening?
Yes, I do.
How much downside are you looking at, say, in the UK market or Singapore market, if you want to talk about that?
I think that most of the Western world and Singapore, right, have seen what happens when property prices drop 50%. We've seen it in Asian crisis, where in Singapore, property price dropped about 30 to 50%. We have never, probably most of you haven't seen it before, but in the West, we have seen property prices drop 30%. And when you drop more than 20 to 30%, the banks actually get into negative equity. A lot of homeowners start to have property values below their mortgage values, and that causes systemic risk. A lot of banks actually get into trouble because the non-performing loans actually shoot up. So I feel that there is a political element of real estate, especially residential. So most governments will start to stimulate real estate once it drops more than 20%. So I don't think it's going to drop more than 20, maybe 10 to 15. So you need to buy on your way down. Okay, property is very hard to time the market and wait for a technical bottom and then recover. Always remember, the moment you make an offer, right, to the moment you complete the property is about 3 months lag. So you might as well be buying on the way down, not on the way up, because the seller will change their mind once the news get better. So you always be prepared to buy on the way down as the news gets worse and worse.
You want to buy when there's more sellers than buyers.
Correct.
When prices are moving down.
When you see desperation. And so I think when it drops more than 15%, you're going to see the government roll back the anti-speculative measures. Maybe they lower the stamp duty. Maybe they tell the banks to increase the loan-to-value ratio. All these will help the property market to form a bottom. So I think it's great opportunity next 12 months. Yeah.
Okay, thank you. So personally, I don't buy physical property. I mainly, well, except for my own stay, of course, right? But I mainly invest in REITs, real estate investment trusts. And again, I see right now, especially the Singapore REIT market, getting really attractive. So I've been dollar cost averaging, adding into my positions. And I'll tell you why. So the Singapore REIT market, the prices have dropped 20, 30, even 40% for some REITs this year. Why? The main reason is because a sudden hike in interest rates have caused a drop in REIT prices. So the question is that, will it rebound? It depends on the type of REIT. So you got to look for REITs that, number one, have low gearing ratios. In other words, if you take the debt divided by the assets, you want it to have as little debt as possible, because if they've got a lot of debt, they have to pay a lot more interest, and that will reduce their earnings and their dividends. So we want REITs that have a gearing ratio, ideally of less than 40%. That's the one, those are the ones I'm accumulating. I also look for REITs that have got at least 75% of their debt, which are on fixed interest rates, so that the short-term rise in rates don't jack up their expenses too much. Third thing I look at would be REITs that have the ability to raise their rents in order to offset the rise in interest costs or electricity costs. So for those REITs, they will rebound. And now is a great time for me to accumulate, because the yields on the REITs are now between 5.5 to 7 to even 8%. Some foreign REITs are 14%. Historically, those yields are 1 to 2 standard deviations above the mean, which means it's at a very attractive level. Now, some of you may wonder, hey, if the REIT is so good, some REITs are really good, why did the price drop so much recently? Why? Right? So one reason is because there were many investors. Last year, they borrowed money from the broker at less than 1%. So they borrowed cheap money, and they used the money to buy the REITs to get a 4% yield. Now that interest rates have gone up, they have to pay so much more interest to the broker, they can't afford to pay it anymore. It can't cover, the yield that they get on the REITs cannot cover their interest costs. So many of them are now forced to unwind their positions. Or if they get a margin call, they are not able to top up the cash they borrowed from the broker. So all this is causing the panic selling or the deleveraging. And that's why you see the REIT prices dropping 20, 30, 40%. So when the REIT drops so much, many times it's nothing wrong with the property, but it's because of liquidity problems of the owners. And that gives us the opportunity to collect these REITs when they are really undervalued. So many of the REITs right now selling below the net asset value, below the price to book value. High yields, I think to me is a great time to lock in 6% yields or more in the future. Bang, you're also invested in REITs, what do you think?
Yeah, I started investing heavily in REITs, I think 6 months ago. And to be transparent, right, my portfolio has been down also, I think about 15% on the REITs, but I collected like 5% dividend, not bad. The thing is, I don't watch it every day. It's a long-term investment, right? I watch once a month kind of thing. For me, investing in REITs is like investing in property, as I said earlier. Then I take a long-term horizon for it. I do invest in the physical property. I also got about 6-7% yield because I bought it a long time ago. I buy a lot of REITs, like you say, below book value. To me, it's a discount. It's like somebody selling you a piece of property at the discount, right? I just buy it because I know I will hold it for many years. And while I'm waiting for the stock price to eventually goes up, I just get the 5, 6, and now 7% dividend every single year. So I just love the risk, especially Singapore exposure kind of risk. The Singapore property, I don't know, it can go down, but to me, it's a rare, opportunity.
I think Singapore is a very small market, right? So even though there's ample supply, our government has built enough commercial property, but think of it, I mean, there's a lot of foreigners that are migrating to Singapore. Just 1% or 2% of the population from India and US or China were to come to Singapore, there's not enough supply.
Yeah.
So it can be very sensitive to sudden demand surge.
So some people may be wondering, hey, I can put my money into the bank and get 3.5-4% interest rates. Why would I want to buy a REIT to get 5 or 6% yield, just a bit more, right? And that makes sense. I would say it's all about diversification.
Yeah.
You need some money into a cash account for emergencies and get some fixed deposit rates. There's nothing wrong with that, but some money to invest in real estate and REITs as well. Remember that when you put your money into the fixed deposit or into bonds, the interest you get is fixed. It doesn't grow, it is fixed. And the interest rates won't remain high forever. Okay? In 1 year or 2 years, once the Fed starts to cut interest rates, your fixed deposit rates will go down, your bond rates will go down. Whereas when you buy a REIT or a property, you're locking in the yield. And over time, the rental will rise. So you're getting an increasing dividend payout over the years. Plus, you also have the capital gain component as well. So it's all about diversification. Don't put everything into one thing, but there are pros and cons. And I see a lot more pros into investing in REITs and real estate than just putting into, say, a short-term bond or fixed deposit. All right, so I do hope you've gained some valuable insights into our panel discussion, and you can see that we all have different approaches, different strategies, and there are many ways to make money in the markets. You just have to find 1 or 2 ways, focus on it, build your competence, and you can do really, really well. And right now, there are so many opportunities out there, whether in the US markets, in the REIT markets, in the real estate markets, in the China markets, the opportunities are there. You just have to have the knowledge and the tools to take advantage of it. And again, remember, do not let a good crisis go to waste, because crises like this, bear markets like this, don't come often. Again, 4 bear markets in 31 years. After this bear market, I'm not surprised that the next one will only come 10 years later. So take advantage of this. Now, right after this panel discussion, I'll be doing my live webinar with all of you. We'll be showing you how to identify the highest quality businesses, the highest quality stocks that are selling at massive undervalued levels right now. And these are the stocks that I'm accumulating myself, because I know that once the bull market begins, they're going to have massive upside. Now, after me, we're going to have our other mentors in this panel doing their webinars as well. So if you could just share, Alson, what will you be covering?
Okay, in my first webinar, I'll be covering how do you avoid bull and bear traps in current markets. I'll share more examples on stocks and even crypto examples. And specifically, I'll be sharing this, one of my favorite strategy, with a very high probability, potent strategy in price action manipulation called Force Strike. So I'll be sharing with you this very special strategy called Force Strike, how I trade in continuation, when market is in continuation mode, and even in reversal mode. Okay, so in my second webinar will be on live trading. So I will be doing this webinar live when when the US market is open, and I'll share with you guys how I actually screen for potential trade setups using the Force Strike strategy that I teach you guys in the first webinar. And what are some of the key details I look out for before I enter, or how I actually exit the trade. And I believe you guys will find it useful.
All right, so Bang, what will you be covering?
So in my webinar, I am going to introduce a new strategies that I have been testing for over 6 months now and been doing very well. And this strategy allows you to prepare to take advantage when the boom returns, right? And I haven't even taught this strategy to my existing students. So first time I show it to you, and I will show you how to construct the trades, the setups. I even, because I'm doing it live, so I may ask you to send in your trade ideas, and I can use the stocks that you send in to analyze and construct the trades in front of you. And I'm very excited to it, and I'm ready to share.
All right, so Jeff, what are you sharing?
So on that day, I'll be sharing about how to analyze properties, not to overpay for it. A lot of people, amateur investors for property, right? They pay for something that is, say, 500,000 worth, they actually paid 800,000. So they never see the light of the day. So I'll be teaching you how to identify places, cities, and areas that will continue to have positive cash flow, high demand area, and low supply. Isn't that what you want? And then the capital gains will continue to come. So if I will share with you tips to look at these points, the must-haves, so that you can do the B4R strategy. At the end of the day, I will also share with you tips like how you achieve 10 properties in 10 years, or heck, you can even achieve 10 properties in 3 years, depending on how hard you work. Effectively, I wouldn't say that you cannot, you can buy properties with no money down. I wouldn't say that. You always need some money down at the start. But how you can grow that little bit of money into 10 properties, into a portfolio, I think that's the trick behind it.
All right, so sounds very exciting, and I'm always the first to watch you guys. And I tell you that over the years, I mean, I've known you guys for many, many years, at least 10 years for most of you, and I've learned so much from all you guys, and I continue to learn through these webinars as well. So for you guys who are watching this, if you want to really upgrade your skills, your strategy, to really be a successful investor or trader, great news, the black market sale is now open, so our courses and playbooks are going at massive discounts, just like the bear market. It does not last for very long, so grab it while the opportunity is there. And next up will be my webinar, where I'll be showing you how I identify the highest quality companies to buy them at undervalued prices in this bear market right now. All right, so coming up next is my live webinar on value momentum investing, how to pick the highest quality stocks at massive discount. Click on the link to join my live webinar.